investor friends, I'm Michelle Markey, and today I'm going to talk about some of my key takeaways from famous investing book, One Up on Wall Street by legendary mutual fund money manager and investor Peter Lynch. And this book originally came out in 1989, and there's an updated edition in 2000 with an updated introduction. And Peter Lynch ran the Fidelity Magellan Mutual Fund from 1977 through 1990, and he was able to beat the S&P 500 by more than double because the Magellan Fund returned 29.2% annualized. So that's an amazing feat for anyone, especially a mutual fund manager who had to manage 1,400 stocks with $9 billion of assets under management. And as always, I greatly appreciate if you could please like and subscribe to my video and YouTube channel, because I'm trying to help you and myself be the best investors we can be. Thanks. While I've gathered about 30 pages of digital notes on this fabulous mini textbook of how to invest, I will not be able to do this book justice for all the wisdom that's in it. So I highly encourage you to go borrow this book from your local library or support your local bookstore and read through all the details that Peter Lynch has shared with us. And I'm super grateful that he wrote this book, because I've been wondering why it's so renowned, and now I finally know why this is such a great book. So go ahead and check it out. And some of the things that stood out to me from his introduction that he wrote around in 2000 was that he said that you don't have to be trendy to be a successful investor. Like Warren Buffett and Peter Lynch are technophobes. So the internet was there in 2000, and during the dot-com bubble, there were a lot of stocks that went and passed him by. Like, he seems to sort of regret missing out on Amazon, and he said Microsoft was a 100-bagger. And he talked about how you can discover a lot of stocks through eating and shopping, and not that they should immediately go on your buy list, but they should give you a lead as to potential companies to consider. And Peter said, most great investors don't invest in companies they don't understand. So with Peter Lynch, he understands things like Dunkin' Donuts and Chrysler, so he invested in those. As well as he said the typical big winner in his portfolio took 3 to 10 years or more to play out. And he talked about how even wonderful companies become risky investments when people overpay for them, like when McDonald's was bid up to 50 times earnings in 1972, and then it went from a high of a stock price of $75 down to $25 to a more reasonable 13 times earnings, or PE. At the time, with all of the dot-com bubble jubilee, he said that in spite of the instant gratification all around him, he continued to invest the old-fashioned way by studying companies' fundamentals, like when companies enter new markets, start growing earnings, and then the stock price follows. And this sort of reminds me of a little bit of a parallel to today. So I kind of wonder what Peter Lynch would think about 2020s and what's happening now with a lot of stocks and SPACs. And he also talked about how if you have 6 out of 10 winners, that produces a satisfying result, and a lifetime of successful investing can come from just having a few big winners. A significant theme that repeats throughout the book is Peter Lynch advocating for the amateur or individual investor over the professional, or where he says that the smart money, aka professional investor money, isn't always smarter than the dumb money or the amateur or individual investor money. So he says that the amateur investor can have several advantages over the professionals in some ways, like learning about companies that are successfully replicating throughout the country even before a Wall Street analyst covers that company, and then also how the information gap has closed. So the amateur investor can read things like Value Line, which I don't even know about because I was a little kid back during the dot-com bubble, so I didn't come across materials like that. But he said that investors could know about companies even before the professionals know about them, as well as how the dumb money or amateur money is more nimble than professional money. Like if there's a lot of assets under management, oftentimes an institution cannot get into smaller company stocks like an individual investor can, as well as there's sometimes these sort of arbitrary rules on Wall Street where fund managers have to pick from a pre-selected approved list of stocks that they can invest in, because maybe some funds will not invest in companies that are at a valuation of up to $100 million. So that means that the individual investor might have room to play in stocks that may not be in the limelight with Wall Street. When Peter talked about the dividend yield becoming somewhat of an endangered species, I find that there's somewhat of a parallel to today, because back then in 1999, he was saying how the S&P 500 dividend yield was 1%, and today it's around 1.3%. And over the last 20 years, it hasn't gone anywhere near 3%. And I can see why he thinks that the dividend's becoming an endangered species, because from the 1880s through the mid-1990s, the dividend yield ranged from anywhere between at least 3% to almost 14%. So I can see why the dividend is starting to go down, and it's because a lot of companies have been favoring more stock buybacks instead of getting double taxed with dividends, where once the corporation gets taxed and then the investor receiving the dividend gets taxed. And stock buybacks make sense when companies are healthy, kind of like what Peter's alluding to, because buybacks can help reduce the supply of shares that are outstanding and thereby increases the earnings per share that remain. And so this eventually rewards investors when the stock price appreciates based on the earnings gradually going up per share. And he said that the dividends, unfortunately, were something that people would look forward to and hold on to stocks, even if stocks weren't doing the best through tough times. And now that's one thing that seems to be not going for stockholders as well. And it shows that there's been a marked change in how companies are motivated to do different things to boost the share price. Peter shared a story about how he was in Ireland during the October 1987 crash, where markets went down by 35% over just 2 days, and how he said never let nuisances ruin a good vacation, and also to not travel when you're light on cash, because there were a lot of redemptions in his fund when that happened. And he said how the crash of 1987 wasn't as scary as what they experienced in 1990, because in 1987 the economy was perking along, banks were solvent, and fundamentals looked good, whereas in 1990 the economy was heading into recession, banks were on the ropes, and they were preparing for war. So we talked about how long bull markets can often hit potholes along the way, and by 1989 the markets had recovered from the 1987 crash. But then you can always run into a recession eventually, like what happened in 1990. And he talked about how bull markets are always scaling a wall of worry. Peter explained that a 10-bagger is making 10 times on your investment. So for example, if you had bought the Subaru stock in addition to buying a Subaru car, let's say, and invested the equivalent amount of a Subaru car valued at $6,410 back in 1977 for $2 a share, that had grown to be a 156 bagger by 1986, or valued at $312 a share. So your $6,410 would have turned into exactly $1 million in only 9 years. And he talked about how that's a fiscal equivalent of 39 home runs. I enjoyed Peter's satirical story of a husband and wife, Harry and Henrietta Houndstooth, where Harry is the designated investor and Henrietta is the person who doesn't understand the serious business of money. And he said, tongue-in-cheek, these roles could be reversed, but usually aren't. And he tells the tale about how Harry invests in a company he doesn't understand, and meanwhile his wife Henrietta buys the fall wardrobe for their daughter from the Limited, which was a 100-bagger company. And by the time Harry finally realizes this is a good company to invest in, the company has already run up in its stock price and has such a high PE multiple that it's no longer a good investment, and it's probably on the downturn as the Limited ended up being. So it's just kind of funny how even though he said that Harry was the designated investor, he didn't end up being such a good investor, whereas maybe if he paid attention, or maybe if the wife Henrietta invested instead, they could have made money instead of squandering their savings on kind of silly investments. The book has 3 main sections, and they mainly deal with preparing how to be a stock picker and then picking winning stocks, as well as how to handle your portfolio for the long term and when to buy and when to sell. And there's a lot of rich technical detail throughout all of these sections that I'll leave you to read the book to really get into it, but I'll pick out some of my favorite things I took away. One of the most important takeaways is that if you are undecided and lack conviction, then you are a potential market victim, and then you lose all hope and reason and sell at the worst moment at a loss. And he says that it's not the stock market nor the company that decides the investor's fate. It is the investor who decides their fate. Peter said there's a lot of groupthink on Wall Street, and this doesn't surprise me because, like he said, they're a very homogenous lot. And individual investors have an advantage over these professionals because we don't have to spend a quarter of our hours explaining our stock picks to our bosses or clients. And also, a lot of these professionals, when they're wrong with their stock picks, they have a lot of indiscriminate selling and they bury the evidence. And we as individual investors can buy back a stock at $19 that we earlier sold at $11 if it makes sense to buy. But some of these professionals could never buy stocks again at $19 that they sold at $11. Otherwise, they'd have their quotrons confiscated, which is another thing that I've never come across, because another relic from the 80s and 90s must have been these quotrons and whatever. So it's kind of funny how we as individuals can have a lot of advantages over the professionals. He also said that individual investors are not forced to own 1,400 stock selections, and he says that he had to do some of that because the SEC requires that he cannot own more than 10% of a company's shares, as well as he cannot invest more than 5% of his fund in any given stock. So he says that he has half of the portfolio in 100 stocks and then 2/3 of it in 200 stocks. And then he has 1% of the portfolio spread across 500 secondary opportunities that if they become better, he then promotes as a primary selection. I like how Peter said that if you're a surfer or an eccentric, you have an edge, because he tries to look for stocks that traditional fund managers overlook. So he tries to think as frequently as possible like an amateur investor, because that's where we can find 10-baggers. In another sign of the times, Peter says we should ask ourselves 3 questions before we buy a share of anything. And they are: 1, do I own a house? 2, do I need the money? And 3, do I have the personal qualities that will bring me success in stocks? And I find it curious that he asks if we have a house, because he says that a house is usually the one good investment that almost everyone manages to make. And he says that a house is entirely rigged in the homeowner's favor. And it's no wonder, because there's a lot of tax deductions with the mortgage interest. And there's also a windfall when we might sell the house and downsize to a smaller house in the future after our kids have grown up. And he talked about how people who are usually geniuses in their houses are idiots when it comes to their stocks, because people spend months shopping for their houses and only minutes buying their stocks. So if you think about it, we should spend just as much time as we do evaluating all the infrastructure of the house and inspecting everything in it, the same way that we would with stocks before we buy them. Peter said that we should only invest what we can afford to lose, and if we do have a loss, that it doesn't affect our daily life in the foreseeable future. And we should have the following qualities of patience, self-reliance, common sense, tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, willingness to do independent research, equal willingness to admit mistakes, and ability to ignore general panic. And he says it's crucial for us to resist our human nature and gut feelings. I love how Lynch includes a few Buffetisms, and to Warren Buffett, the stock market doesn't exist. He says it's only there as reference to see if anybody is offering to do anything foolish. And if we had invested when Berkshire Hathaway was at $7 a share in the early 1960s, this would have become $4,900 in 1989. And never mind that, it became $430,000 a share for Berkshire Hathaway A shares in nowadays 2021. And so if we had invested $2,000 back in the early 60s, that would have become $1.4 million by 1989, a 700-bagger. Along with nuggets of wisdom like how Taco Bell soared through 2 recessions, Lynch often includes a lot of bite-sized bullet points of key takeaways and checklist items that we should all bear in mind when we're putting together our own investing checklist. So you can reference a lot of these bullet points at the end of a lot of sections. Peter describes this concept of diversification, which is also known as diversification, when companies buy ill-fated subsidiaries that later on they are unprofitable and then they have to restructure them out of the company because they were bad acquisitions or mergers. So then the company has to then turn itself around. And so he considers when companies do this kind of excess activity as diversification, which is a little different from how Charlie Munger thinks of diversification, where it's a similar thing, but for Charlie, it's where you're buying too many stocks. And the irony is that Peter Lynch bought tons of stocks in his mutual fund. So a little bit of a different definition for the term diversification here. I found it really helpful how Peter categorized companies in the following 6 categories of slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. And with slow growers, we can think of these as utility companies like electric and water, and computers, chemicals, steel. And a sure sign is when they have a generous and regular dividend. And with stalwarts, these are the Coca-Colas, Bristol-Myers Squibb, Procter & Gamble, Hershey's, Ralston Purina, and Colgate-Palmolive, and they usually have a 10 to 12% annual growth in earnings. And another thing is that they can usually raise their price because everybody needs to buy food and they enjoy drinking soft drinks, so they will be sticking around as stalwarts. And then there's fast growers that are the small aggressive new enterprises that have 20 to 25% growth per year. And if we choose wisely, this is the land of the 10 to 40 baggers. Even the 200 baggers are in the fast growers. And cyclicals includes when sales and profits rise and fall in predictable fashion. And this is with cars, airlines, tire, steel, chemical, and even defense companies would be considered cyclicals, because defense companies' fortunes change with different administrations. And there's turnarounds, which are the battered, depressed, and barely dragging out of Chapter 11 companies, like when Toys R Us emerged from a bankrupt department store company. And then there's also asset plays, where a company is sitting on something valuable that Wall Street has overlooked, like when there's a company that owns a rock pit. So this is also a really good way to make sure we're keeping track of different facets of companies and where they are in their stages of, sometimes they start out as a fast grower but then become a stalwart, or they become a slow grower. Putting stocks in categories is the first part of developing the story or the investment case, as I interpret it. And Peter Lynch is attracted to companies that have dull or even better ridiculous names like Pep Boys, and also Service Corporation International, which specializes in funerals and burials. And he also says how a lot of people don't want to invest in disagreeable things like waste management or Cajun cleansers, even though they're phenomenal businesses. And he also talked about how could the Boston Globe lose? And this is a popular newspaper in the Boston area. And in retrospect, I know how that kind of company could lose, because they couldn't foresee that companies like Google and Facebook were going to take a lot of the advertising revenue to the internet and leave a lot of the newspapers kind of struggling to survive. So here's a list of some of the other reasons to go after some stocks, as Lynch put them. And I won't go through all of them, but it's worth going through all of these reasons when you're thinking about which stocks to look into to possibly buy. I also enjoyed how Peter kind of likens company types to a sort of person type. So for example, a Dunkin' Donuts is a potential fast grower, and that's why they're kind of like an actor, like when Harrison Ford was maybe doing stuff around LA before he had a hit movie like Star Wars, and how this is very different from Coca-Cola, which is a stalwart, or also kind of like a corporate lawyer with steady earnings. I don't know if our stock market these days has permanently deviated from some of these historical averages that Peter talks about, but he says that on average, a price to earnings ratio is how many years you can expect to get your money back. So if something has a PE of 10, then you can expect to get your money back in 10 years. And he says how utilities usually have a PE ratio of 7 to 9, stalwarts have 10 to 14, and fast growers have 14 to 20 of a PE. So with some of these PEs being totally blown out of the water these days, I don't know if this still holds true, but I certainly like to hope it does. He said how normally the PE ratio of a company is the same as its growth rate. So if Coke has a PE of 15, then its growth rate is 15%. And if we can find a company whose PE is lower than its growth rate, then we may have a potential bargain. And I tried experimenting with this formula that he offered, where if we take the growth rate and we add that with the dividend rate and then we divide that by the company's PE, then we could see if we might have a potential buying opportunity. And this gives us a way to compare the growth rate and earnings. So I took the 10-year earnings per share growth rate of Starbucks and Apple, and I did this formula for both of them, and I found that when I added the 10-year growth rate for earnings per share, and then I also added their dividends together and divided by their respective price to earnings ratios, I got values that were definitely below 1 for both Apple and Starbucks. And Peter said that if we have below 1, then this is a poor choice, and then 1.5 would be okay, but having a 2 or better would be best. He also talks about how we want to have a company with a strong balance sheet, like way more equity than debt, like at least 75% equity to 25% debt, if not more equity. And he also talks about how we want to have plenty of cash, and so much so that it will offset whatever long-term debt there is, and he's not too worried about the short-term debt. And he also says, all things being equal, he would rather invest in a 20% growth rate with a 20 PE company over a 10% growth rate, 10 PE company. Peter said mutual funds are a wonderful invention for those who have neither the time nor inclination to test their wits against the stock market. And with index funds like the S&P 500 giving a yield of around 10% average rate of return per year, if you want to make stock picking worth your while, you ought to be getting a 12 to 15% rate of return compounded per year. And he says that with commissions, which were around 4% back then if you turned over your portfolio once a year, which actually is kind of high. So we're a little bit spoiled with having zero commission fees these days. But if you had that 4% you had to account for in fees, then you really needed to earn a return of 16 to 19% back then to just get your 12 to 15%. So this is food for thought for those of us who think that we can do better than the stock market average and pick our own stocks. In slightly different words, Peter says that in order for us to make a profit in stocks, we have to convince ourselves that when we're down 25%, we're a buyer and banish the fatal thought of when I'm down 25%, I'm a seller. Peter has a list of the 12 silliest and most dangerous things people say about stock prices, and I'll just quickly throw them up here so you can pause the video and read the list. But just like Peter Lynch is human, we all are, and we all occasionally get faked out by the market and make mistakes too. A few final takeaways I'd like to share with you is how Peter said small investors are capable of handling all kinds of markets as long as we own good merchandise. And he says that his biggest winners continue to be stocks he's held for the long term, at least 3 to 4 years. And he says he's always fully invested, and we got to keep our priorities straight if we plan to do well in stocks. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.